Hello, Matthew Copley with Copley Financial Group, and today we're going to do another market update. It's been a few weeks since we did the last one, so I want to get everyone up to speed on what's going on in the markets, what we're watching for, and some of the things that are being talked about online and in media, like the BRICS conference that's happening right now, and also some of the issues we're seeing, slowdown in China, so on and so forth. So before the market update, I would like to let you know that we would like you to use support@copleyfg.com. Anytime you need assistance or help with your accounts, I think it's really important to be able to provide the highest level of service for our clients and our customers. And I want to make sure that there's always someone here that can respond immediately. So for example, if you are used to working with a certain support person, we want to make sure that if that person for whatever reason is not available on vacation, that you have immediate assistance. And the way to do that is to include, anytime you make a request, need a change in your account or an update, just include support@copleyfg.com. That's support@Copley, F as in financial, G as in group.com. And so hopefully that'll be helpful in making sure that we're giving you the customer service and the response times that we'd like. And with that, market update. Well, bottom line is this is happening exactly as we expected. We're seeing a lot more recession indicators, and so we're monitoring what's going on in the market. And the market, stock market itself is actually down a little more than 4% since the last update. Our clients are doing much better than that. In fact, most of the people are down less than 1% because we're positioned very, very well for this. But yeah, we're going through a big problem with the stock market. You're seeing across the board a lot of weakness. And this has to do with a lot of the recession indicators that are starting to come out. A lot of the leading indicators show that unemployment is ticking up, and just overall sales and earnings are coming down. So we're positioned really well for this. This is kind of what our expectation was. So we really don't need to change anything with what's going on in the market. I think this will continue to play out for the rest of the year. We'll see these problems as interest rates continue to stay high. It's causing a lot of problems with the financial markets. I just saw this morning the 30-year fixed rate is now up to 7.5%. This is obviously going to have a huge impact on the housing industry and everything involved with someone purchasing a house. Now might be a good time if you are thinking about selling your house anytime soon. Now may be a good time to start working on it quicker, sooner rather than later. And that's just because houses could be impacted by these high rates pretty severely. Now, that assumes these rates stay up for a long time. And this is what a lot of the consensus estimates are, that rates are going to stay up here for a while. But if you look at the fixed income market, the bond market, they're signaling that rates are coming down next year. And so there's kind of a weird thing that's going on right now. The short-term rates are much, much higher than the long-term rates. So if you take out money, if you invest money for a year or a year and a half, you're going to get a much higher interest rate than if you invest for 3 or 4 or 5 years. And this is because the short-term rates are higher. So there's a lot of people on Wall Street. These are big investors and Wall Street people that they're betting that interest rates are coming back down next year. So why would someone that can put money away for 3 years at 5% interest, or they can put money away for 30 years at 4% interest, why would they put their money away for 30 years? This doesn't make any sense. Well, what they're betting on is that the short-term rates go below those long-term rates. In other words, if they can get 4% now for a very long period of time, they want to take that because they think the short-term rates are actually going below 4% in the future. Now, is that going to happen? I don't know. That seems like an unlikely scenario given the inflation data that we're seeing. I think that's probably a bad bet, but this is what a lot of people on Wall Street are betting. And so obviously we're being careful. We don't want to be part of that crowd that's taking that bet. We want to stay short duration. If we're going to go into guaranteed interest, we want to be in 3 years, 5 years, kind of the sweet spot on that. We don't want to lock up our money for longer periods of time at these rates because there's no guarantee what rates and the market's going to look like in the future. So one of the things that is a big topic right now is the BRICS conference. And so just a quick summary of what this is, what the BRICS are. So the BRICS is BRICS, which stands for Brazil, Russia, India, China, South Africa. And there's a lot of hype, a lot of media hype around this. Of course, there's a lot of people on online and social media saying this is the end of the US dollar, they're getting rid of the dollar, the BRICS are coming out with their own currency, it's going to be backed by gold, and the US dollar is toast, and the whole bit. That's not going to happen. Okay, so the US dollar is going to continue to be the world's reserve currency. In fact, even if the BRICS do what they say they're going to do, the US dollar is part of that process. They have to have the US dollar for the BRICS to work, because this isn't going to be a walk around currency. They're not issuing a currency that people can use to buy things. That's not what the BRICS is. The BRICS is really a trade currency. So what's happening now is the US has weaponized the US dollar, and how they did that is when Russia invaded Ukraine, what ended up happening is the US government decided to just take all these Russian people's assets. These are people they were Russians, oligarchs, people that had money in our Western systems. They just took their money and stole it and gave it to the Ukrainians. Well, the rest of the world was watching this happen, and they said, well, wait a minute. If the United States decides that we're not doing what we're supposed to be doing, the people of China and India and South Africa and other countries, would they do this to us? Well, they did it to Russia, so maybe China wants to invade Taiwan. Well, they can't have all this money in the system that can be frozen by the United States. So they want an alternative. They want to come out of the US dollar. So a lot of these countries are doing bilateral trade agreements. This is where they're basically transacting between countries, like barter. Saudi Arabia is selling oil to China, Russia is selling oil to India, and they're doing bilateral trade agreements. But the problem is, if Russia really wants to buy copper from Brazil and they're selling oil to India and they're getting Indian currency, India doesn't have the copper. Maybe they have enough things that India produces. They don't want to buy anymore. They want to buy something from Brazil. So the bilateral trade agreements don't work. You have to have a common currency trade unit. So this way, the people of India would actually pay Russia in BRICS, this new trade-weighted currency, and then Russia would be able to use that currency to buy, say, copper or whatever they want to buy from Brazil. So this is really a system that would have an impact on the United States and the US dollar. It wouldn't wreck the dollar, but it would cause it to potentially lose value over time, which it's already doing. It would just speed up the process and create more inflation. But here's the problem. You have to trust all the people within the system. So I don't have a lot of confidence that anything's going to come of this. They're talking about a trade currency that's weighted by gold, and so you have gold backing, which is what you would need to do. I know going into this, all of the BRICS countries were talking about using a commodities basket, where you had oil and copper and different things that were a basket of commodities. And we've seen this before. They tried to do this during the Bretton Woods system. And the problem with that is all those commodities are different. Right? Copper in Chile is a lot less expensive than copper in China. And that's because there's a lot of copper that comes out of the ground in Chile, and there's not that much demand for what the supply is. But in China, they need a lot of copper, and not a lot's coming out of the ground. So you can't really have a basket of commodities when they have a different price at different spots around the world. Same thing with oil. There's so many grades of oil. Oil that comes out of one area, sweet crude versus dirty crude versus this or that. So at the end of the day, you've got different types. And so there's only one thing on this planet that is the same value, that has a high value in a small weighting. It's only one thing on the whole planet that's the same price everywhere and that is recognized as a backing, and that's gold. Gold has to be it. Gold is what is going to ultimately be used in any trade-weighted currency. So, and this has been what's been talked about, that BRICS are going to back their trade with gold. But this still requires each country to have trust in the other countries. So if China has issues a bunch of these currencies backed by gold, and India issues a bunch of currency backed by gold, and Brazil issues a bunch of currency backed by gold, they got to trust that all those countries actually have the gold, and if they're called on to exchange the gold, that it's there and that they'll do it. Right, and I think that that's a big question mark. I don't think a lot of these countries can be trusted, and I think the rest of the world gets this, even within their own bloc. I think that there's a lot of potential problems, and it's also leads into the fact that China is having a lot of problems right now. The Chinese economy is a mess. And so these other countries are going to have to rely on China to tell the truth. And they're already doing all kinds of stuff with their data where they're not telling the truth. They've just stopped reporting unemployment for the youth, for the young people of China, because they don't want to show the numbers. And so when you don't have trust, this makes it a lot more difficult to have some kind of a currency. So I'm not that worried about the BRICS. I will tell you that with what they're talking about, creating this trade unit backed by gold, essentially they're making a bet that gold is going to go up in value against the US dollar over time. And that is 100% accurate. And so we want to own gold. We want to have gold as a protection against inflation. I don't know if that inflation is going to be caused by the BRICS and these other foreign. I think it's going to mostly be caused by Washington, D.C. running massive deficits, right? Printing a lot more money to pay for government programs, not having enough taxes come in to pay for that. So when you run massive deficits, you're going to create inflation. So I think the problem with the US dollar does not come from international sources. It comes from within. It comes from our own government spending too much money, more than they take in. So that said, we are seeing a slowdown, right? China's a mess. All their economic numbers say that they're not shipping as many goods around the world, which means the rest of the world's not buying them. And we're seeing this in a lot of data. FedEx recently just had, I was reading FedEx, their earnings reports, and they're crashing. All of the supply chain is really coming down. We're seeing shipping, the amount of shipping, really, I mean, the words they're using is crashing. So the amount of goods being shipped is down. And so this is something we got to watch. At the end of the day, this signals a recession. And what comes of this is a recession that potentially is going to start later this year, early 2024. Well, what happens in a recession? Well, people need to eat. They need to put gas in their cars. So you need to be invested in companies that produce the necessities, which we are. And it also means the government is probably going to lower interest rates back down to combat a recession, because that's what they do. That's one tool that they have, is to lower rates back down, incentivize more loans, more lending, more credit to help with a recession. And so if that happens, we're going to get a lot more inflation. So it's a catch-22, and this is exactly what I've been saying for the last few marketing videos, is we are going to have a recession and inflation at the same time. So we have to be positioned with the investments, which we are. We're in a great position. We've got investments to do well, both in up markets, in down markets. I believe that if there's a significant downturn in the markets, all of our buffered indexes, our insured accounts, the annuities, they're going to be guaranteed insured payout reimbursements. And if the market really takes off because of inflation and prices go wild, well, all of the stuff that we're invested in energy and agriculture and precious metals, they'll go way up. So I think we're positioned really well for this. At the end of the day, we're watching what's going on. If you have any questions, feel free to reach out, and we will definitely review all the accounts, looking for opportunities based on the current environment. If you have any questions and want to learn more about, some of the guaranteed rates, obviously we want to take advantage of being able to get 5%. We have a new company now doing the MIGAs. Currently we have one at 5.5% on a 3-year. It's the highest rate I've seen in a long time. It actually went up. We were getting 5.4 at one point, and it dropped down to about 4.9, and now we have a new one at 5.5. So definitely take advantage of that. Put your money away for 3 years, 5.5% guaranteed interest. And so just a great opportunity to lock that in while you can. The new buffered index we have is a fantastic one. And I mentioned in previous videos I was going to start talking about what the current ones are. So we have one mid-September. It's a 23.8 cap. It has a 20% insurance buffer, which is fantastic. The company, the underwriter, is Goldman Sachs, very strong underwriter. So you can earn up to 23.8% cap. You've got a 20% insurance, and it is dual directional. So it does pay if the market goes down 5 or 10 or 15, you actually get the inverse return. So it's a great product that's out there. And obviously we want to focus on those and value stocks. I hope this was a good market update, and remember to use that support at copleyfg.com when reaching out to us. It'll definitely give you better customer service and allow our team to help you. Certainly feel free to give us a call at the office here. We're more than happy to chat with you about anything on your accounts. And so I hope that was a good market update. Thank you all for watching, and I hope to see you in our Mission Valley office very soon.